Hello, this is Nick Paulson with the farmdoc team at the University of Illinois. For the 2026 crop year, a new crop insurance endorsement called the Margin Coverage Option, or MCO, is available. MCO is an area-based product protecting against operating margin declines driven by falling output prices, area yield losses, and/or rising input costs. In Illinois, corn and soybeans are eligible for MCO coverage in 2026. The sales closing date for MCO for the 2026 crop year is September 30th, 2025. MCO offers coverage on an expected operating margin, which is the difference between measures of crop revenue and a cost index covering a limited set of inputs. MCO's revenue component is based on the same county yields that are used for other county or area-based products, such as the supplemental and enhanced coverage option programs, and futures prices for the crop being insured. What is included in MCO's cost component varies by crop. For corn, the cost index includes urea, diammonium phosphate or DAP, and potash fertilizers, along with diesel fuel. For soybeans, DAP, potash, and diesel fuel are included. Potash costs are based on a formula that uses urea, DAP, and natural gas prices. Futures prices for urea, DAP, and natural gas are used with predetermined quantities of the inputs that vary with yield for the covered crop to construct the cost index portion of the MCO margin guarantee. Similar to existing federal products, projected prices and the projected margin are set based on futures settlement prices during a price discovery period. For MCO, the discovery period is August 15th to September 14th. Final or harvest prices are set during a harvest discovery period. For the futures impacting the cost portion of the MCO margin guarantee, the harvest discovery period occurs during April. The discovery period for the harvest price for corn or soybeans is October. May futures contracts are the basis for prices for the inputs, and the December and November contracts are used for corn and soybean prices. For corn and soybeans, producers have the choice between two coverage levels for MCO, either 95% or 90%. In either case, the coverage band extends from the coverage level down to 86% of the guaranteed margin. Producers can also elect a protection factor with options ranging from 50% to 100%. MCO payments can be triggered by sufficient declines in the calculated margin that are driven by crop price declines, area yield losses, and/or increases in the cost component driven by input price increases that might occur during the coverage period. Thus, MCO provides coverage against declines in the projected margin based on futures price changes for the insured crop from late summer of the previous crop year through the crop's harvest period, deviations of area yield from expected trend yield estimates for the crop year, and futures price changes for the included fertilizer and fuel inputs from late summer of the previous year to the spring of the crop year being covered. For 2026, this means projected prices were set in August 2025. MCO purchase decisions must be made by the end of September 2025. The final harvest prices from input futures that impact the cost portion of MCO are determined in April of 2026, and the final harvest prices for corn and soybeans are set in October of 2026. Finally, payments, if they are triggered for MCO coverage, will not be determined and paid until June or July in the summer of 2027, after final county yields are released for the 2026 crop year. Here are some additional important points to be aware of as you consider MCO coverage as part of your overall crop insurance portfolio for 2026. First, MCO is an index product based on futures prices, area yields, and predetermined input quantities. Your farm's margin between crop revenue and fertilizer and fuel costs will almost certainly differ from the MCO calculated margin. MCO coverage requires the producer to carry underlying coverage from one of the combo product plans, which include revenue protection with the harvest price exclusion, or yield protection, all of which will continue to have sales closing dates in March for corn and soybean coverage in Illinois. MCO coverage will follow that of the underlying product in terms of whether the guarantee includes the potential harvest price increase. Additionally, the projected corn or soybean price for MCO coverage will be different than the projected price on your underlying plan of insurance since they have different discovery periods. Producers choosing to use MCO will also be able to purchase SCO coverage in 2026 in the spring, but will be ineligible for ECO coverage due to overlapping coverage between the two products. In addition, area plans cannot be used as required underlying plan of insurance. Again, the producer must purchase coverage using RP, RP-HPE, or YP. MCO premiums will be subsidized at a rate of 80%, which is the same subsidy rate that will be used for both SCO and ECO plans for the 2026 crop year. More information about and analysis of MCO is available in the FarmDoc Daily articles and the RMA resources linked in the video description. The RMA resources on MCO include links to an MCO fact sheet, information on where and for what crops MCO coverage is being made available for 2026, and answers to a number of frequently asked questions. We also encourage farmers who are interested in MCO to contact their crop insurance agent with specific questions about their personal farm situation. Thanks for tuning in to this 5-minute FarmDoc video. We invite you to become a subscriber of the FarmDoc YouTube channel so you can more easily access the videos we release to help inform our stakeholders about developments impacting agriculture.